It's an urgent message. I'm your host, Steve Metre, and thanks for joining me today. In our show today, we're going to discuss a topic that you may have heard from other YouTubers is not permitted. That's right, some content creators are getting outright banned. Others, including myself, have gotten their hand slapped for putting out videos about certain subjects, and we're going to broach that today because I think this is extremely important. And the reason why I may have to delete this video within 24 hours is because if it gets flagged, well, it's got to go. And I want to talk about how the political elites are going to solve what they perceive as the biggest problem for the U.S. economy. But we're going to actually take a look at what's affecting U.S. consumers right now and why we are literally on the brink of a massive recession. I'm going to show you what the tipping point is, but now let's head over to Bloomberg where we talk about a subject, well, we're not allowed to, as economic proposals envision tax cuts and subsidies, as we see now focus on core expenses of American life, and this contrasts with the current administration's response to price complaints. And if you're wondering why I'm not saying certain words or names, well, let's just say I'm not allowed to. But let's take a look at what the proposed plan is going to include, as we now see child tax credits potentially being increased, and there's also a proposal for expanding the earned income tax credit for low-wage workers who don't have children and increasing subsidies for those who purchase insurance on federal health exchanges. And these plans are being put forward to deal with the number one complaint that U.S. consumers have, and it's inflation. And the reason we're talking about this is because I want you to see that the political elites do not understand what people are going through. They don't understand the problem, and they absolutely don't understand how to solve it. She also envisions new price controls on groceries and expanding limits on out-of-pocket prescription drug prices to all Americans. Tens of billions of federal dollars would be spent to improve the supply of federal housing while pledging to implement new rules to prevent corporate and landlord price gouging. So you see kind of the view here is that certain people just need more money, and while other businesses need to be kept in containment with their prices. But does this work? Well, not exactly, because the World Bank a couple of years ago described temporary price controls as, quote, the second best option, given they can be inefficient and costly, though the bank acknowledges they have a key role of keeping inflation expectations in check, provided they're designed well. But the question then becomes, if this isn't the best option, what is the best option and why aren't we doing it? We're going to talk about that as we get into what the real problem with the U.S. economy is and why these plans just won't work. In fact, there's a potential $25,000 proposal to assist first-time homeowners secure mortgages that threatens to further push up housing prices. And so you see these policies, they just don't sound like they're the right answer to the problem, because what is the issue here is we're seeing inflation from the post-pandemic stimulus, and it hasn't quite cooled off yet. But is inflation really the problem? Well, many people say it is, but what is the actual solution to that? Well, let's take a further look at what's going on. Because even as economists point to supply chain disruptions and the federal government's pandemic area stimulus spending as a major factor in price increases, Democrats argue that inflation, which peaked at a 40-year high of 9.1% in mid-2022, has been driven by corporate profit padding. And many Americans agree, as they found in recent polling and focus groups. And so here you kind of see the view is maybe corporations are just going too far with their price increases, and they're really hurting the average American. But that's really not the problem, because when you look at an economy, inflation isn't a horrible thing if people can keep up with it. And now we start to get into what the root problem with the U.S. economy is. It's not creating the opportunity, it's not creating the jobs, and it's not creating the wage growth that people need to deal with inflation and create demand. But one thing we're seeing big demand on and big returns, that is our reports that we show you how to trade the market to make money. Now, I know some of my buddies, they put out reports and say, look at these outlandish returns that you can't duplicate. Right now, between my two reports, we have 39 open trades, 33 of them are up. That's an 85% win rate. Here's the best thing. You could duplicate each and every one of them. We tell you exactly when to buy. We show you how to sell. We do everything. And there's two ways we do it. One, we look at the machine positioning. When these machines get really short in their positions and we scan the major equity, bond, currency, and commodity markets, and we see price move against it, well, that flags our report. But maybe you like to trade momentum, but you find yourself getting in late, out early, and all over the place. Well, we look at momentum over a 1 month, quarterly, and 6 month window. And when we see a reversal offer a deep momentum pullback, well, that flags our report as well. But here's the best part. You get the reports. You get every tradable signal. And then I review each and every one of them. I tell you when to buy them. I give you the stop loss levels. I even update the stop loss levels for you once a week. We also track and the returns, even the good ones and the bad ones, so you can duplicate everything. And the key part here, 30-day free trial, link in the description below. You know why my buddies don't do it? They just want your money. We want you to make money. But let's talk about what the issue here with the consumer is, because there are times when consumers are happy about the economy. Things are booming, and you can see why. When we look at the consumer price index against total compensation growth, well, inflation isn't a problem. Again, if people are seeing their wages grow and they're getting the hours work they want because they can afford higher prices. And then you start to understand that inflation is a function of demand. So when you're seeing a healthy amount of demand from the economy, well, the prices are going to go up, but everybody benefits. And so now we're seeing, of course, the opposite problem is a lot of stimulus in the economy jolted things way up. And now we're about to experience what's coming off that sugar high of the sugar rush of the economy and the stimulus. And there yet isn't an answer. The problem seems to be is let's just put a cap on prices, when really we should be focusing on the underlying economy. And let's take a look, because we can see there's periods. You look at like post 1990 recession here, and you'll notice total compensation growth. This is shown as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. It's trending right at or above inflation. This was considered a good time. This was back when I was in high school and after high school. And one thing I didn't worry about, in fact, no one was concerned about, was getting a job. There was plenty of them. And if you didn't like your job, was okay, you could go get a different one. It was a really good time, and people went out and spent money because they could keep up with inflation. Now, as we move forward, you'll notice what happens is when inflation gets ahead of total compensation growth, well, we tend to eventually end up in a recession. But we come back again now post-dot-com bubble, and what do we see? Total compensation growth growing, keeping pace, in some cases outpacing inflation. Again, considered a boom time before the recession hit. And then you look at the cycle now after the global financial crisis, and what happened? Around 2012, what happened? We see it again. Inflation has cooled off, total compensation growth is growing, and everything's good. But this part right here where you see the red line below the blue, well, that was where a lot of consumers got behind. And right now, political elites are saying, look, you should be okay. But the problem is that structurally, underneath the economy, there's a really, really big problem, and we find that out now from the University of Michigan in the Consumer Sentiment Survey that was just published today. And U.S. consumer sentiment increases now for the first time in 5 months. We get some preliminary data here, given sort of a pulse that maybe the U.S. consumers are feeling slightly optimistic on, of course, what's going on with the economy. Now, that showed up in the retail sales data, which we know was largely due to, of course, a pull forward in auto sales. But the real issue here, are consumers getting ahead? Well, the data says yes, but of course, the data doesn't include everything. But let's take a deeper look at the report, because U.S. consumer sentiment rose in early August for the first time in 5 months on more optimistic expectations about their finances as inflation steadied. And that's really key to understand here, because what are consumers seeing? Well, they're seeing the labor market relatively hold up, and that's a good sign. They're seeing inflation cool off, and while they are behind from all of the debt that was taken on during the pandemic, all of the price increases, the higher energy costs, they're starting to think that maybe this is all going to work out, until it doesn't. The sentiment index climbed to 67.8 from 66.4 in July. Again, this was a preliminary reading for August. The estimates called for 66.9, suggesting consumers are indeed more optimistic than what the experts suggest. But let's take a deeper look here, because it makes sense when consumers feeling they're getting ahead of inflation. Yes, their expectations of the economy, the sentiment surveys reflect it. So let's overlay the University of Michigan Consumer Sentiment Survey against the last chart. And what we know is during that good time of the early 90s all the way into the dot-com bubble, what happened? You see sentiment rose as shown here in the green line. What happened in 2005 era? Well, after the dot-com bubble burst and then the economy rebounded, you see sentiment went up again as consumers started to get ahead. Look at 2012, right into the pandemic. Consumers were feeling optimistic, and this time they started to as well. But we noted there was a link to this recent increase in the equity markets because a lot of people look to the stock market as a proxy for the U.S. economy. Now, one of the problems with the stock market is it's one thing people are investing in because there isn't a lot of opportunity in the economy. And that's really my key point here is you're seeing the political elite saying, look, we just need to put price controls on. What we really need to focus is on the underlying economy, creating opportunity for people to invest and start businesses and grow the economy. And the problem is there really isn't that opportunity. And that's why we're seeing here this big decrease in consumer sentiment. But it's happening at a time when consumers should be more optimistic, but the report said, well, maybe we're not that optimistic as it seems. But what I'd love to get your pulse on today's show. Weigh in the comments. Do you think price controls are the answer, or do you think we need to focus on the structural issues of the economy? Because as you're about to see, we may be far closer to recession than many people believe. As consumers now expect prices will climb at an annual rate of 2.9% over the next year. That was unchanged from last month. And also they see costs rising 3% over the next 5 to 10 years. And that's why we're seeing a little bit of increase in optimism. Again, it's all coming back to the labor market. Now, where do consumers get their inflation expectations from? Well, right here, that's called gas prices. As we look here in red against University of Michigan inflation expectations, while they're saying inflation expectations are likely unchanged, we see gas prices still slightly elevated. You'll notice the two are not perfectly in sync, but they head in the same direction, suggesting that consumers realize inflation may be here to stay, at least for a little bit. We've noted that it will come down. In fact, in the show the other day, I mentioned I do believe the trend for inflation will gradually decline until, of course, the labor market breaks. When that happens, well, watch out. We know exactly where inflation will go, and that's down. And the rise in sentiment was partially driven by President Joe Biden's decision not to seek re-election when he announced later in July, as confidence rebounded among Democrats after Vice President Kamala Harris stepped in as a party nominee. And you can see that here with future expectations of Democrats feeling more optimistic now about their chances to retain the White House, and that helped the survey a little bit. But does this all translate into spending? And that's really the key here, because if it doesn't, then we start to find out that the labor market is right on the bubble, right at an inflection point of coming unwound. And the survey showed more consumers believe Harris would do a better job on the economy. And before Biden's decision, Republican nominee Donald Trump had been polling well ahead of him on that issue. And even with the latest pickup, sentiment remains restrained by higher cost of living, cooler hiring. And there's the key point. And you look at those two together. When you have higher cost of living, of course, you're going to have cooler spending, because it's what the report here is suggesting is that consumers aren't keeping up with inflation. Meanwhile, the government data says no, total compensation growth is outpacing inflation, but perhaps there are things that are not showing up in the consumer price index that we're seeing that the average American is being forced to spend on, and that's causing them to cut spending on the discretionary side. That is something we note is indeed happening. But what we can see, elevated borrowing costs also a factor here, and that doesn't show up in the CPI. Of course, we know that Americans took on a lot of debt and at high interest rates now to keep up with inflation. And while household demand remains resilient, well, I don't agree with that. Consumers are increasingly turning to credit cards and resorting to savings to support their spending. And we note that saving levels have dropped. And we now also note that when consumers turn to their credit cards, there is a point where they reach the red line, where they reach the limit and the banks won't extend any more credit, that's when the game is completely over here. Because again, it all comes back to the labor market. And let's talk about consumer sentiment, now shown in blue, against continued unemployment claims, because what we can see is, yes, you can have periods where consumer sentiment is high and rising and everyone's optimistic until you see continued unemployment claims start to steadily rise, and that's an indication that those losing their jobs can't find other work, and next thing you know, slowly but surely confidence starts to erode, and then it plummets as we head into a recession. And right now we're seeing a very gradual increase in continued claims and no sign of unwinding of that. Now we are seeing initial claims remain historically low here, but that's not giving employers any confidence to bring back people or to create new jobs, and there's good reason for that. I'll show you here that in a little bit. Because the report showed a measure of buying plans for durable goods slipped to the lowest level since the end of 2022. And yet, where do we see in the article? It says right here, household demand remains resilient, but it doesn't, because we're seeing buying plans plummet. And we can look at this chart right here provided by Zero Hedge. You can see the consumer confidence remains elevated as hope is the plan, but people are not spending money. Now, I wish this data was in the Federal Reserve database, because I would love to overlay the unemployment data against that chart, because when you see people spend less, and it's very shocking. You see it happen here in 1980 to 84. You see it happen right going into the 1990 recession. You see a little bit of pullback into the dot-com bubble. How about the global financial crisis? This is worst data in 40 years we're looking at here as consumers focus on retrenching. And what that indicates is that people are about to lose their job, because when demand goes away, employers don't have the revenue to keep them on the books. And still, labor market expectations remain stable, or at least for the moment. And this is from the consumer's view, as just 35% of respondents said they expect the unemployment rate to rise in the coming year. Well, that number is going to go way up, and I'll show you why. The share of consumers who expect interest rates to decline the next year rose significantly, but that's because we're hearing from Fed Chair Jerome Powell that there's likely now going to be a cut in September, or if not, the market is suggesting there is going to be one in the near term future. The Consumer Expectations Index looking forward 6 months rose to a 4-month high of 72.1, while the current conditions gauge slipped for a 5th month. So what we're seeing in the data, particularly as we look at this chart here, currently consumers are not optimistic, but they're hopeful. They're hoping things get better, that perhaps the soft landing was just deferred. But coming back to the unemployment rate, we noted it's going to go up. Consumers don't see this, perhaps because they haven't lost their jobs, they're seeing their hours cut back significantly. But we can note, as we look at the U3 unemployment rate in blue, it is a lag of the continued unemployment claims. This is why the most critical data that comes out any given week, that's on Thursday, is continued unemployment claims. If we continue to see that go higher, you're going to see the U3 unemployment rate go higher. That means consumer confidence is going to come down, as well as a non-farm payroll report, and that sets up that we're exactly into a recession at the worst possible time, because we're heading to the holiday season where a lot of businesses need spending to happen, and not looking good at all. In fact, the New York manufacturing contracts for a 9th straight month. So we talk about the labor market coming undone here. We talk about the problems with the economy. It's all about consumers. They're just not seeing the opportunity. Businesses aren't seeing the opportunity, because if there was, inflation would not be that big of an issue. There would be enough demand from the consumer level that businesses would have no problem demanding more employees, paying them higher wages. Things would keep up with inflation, and it would be just fine. But now we're seeing the manufacturing sector get even worse. As the Federal Reserve Bank of New York's August General Business Conditions Index rose 1.9 points to minus 4.7, still below the zero reading that indicates a contraction in the measure of new orders. And this is key, because we talk about, the report said that consumers were stable, their buying were okay, but look at the expectations. It was plummeting, and that's exactly what the manufacturing survey is suggesting here, as the measure of new orders declined 7.3 points to minus 7.9. line, while it gave us employment, showed a 10th month of contraction. Again, there just isn't enough work to keep people there. And the index of hours worked shrank at the fastest pace since March of 2023. So again, what are we going to see in future reports? Well, that means total compensation growth is going to plummet. That's something we've noted happens because demand is going away. The two get linked together. When inflation goes down, when the government tries to contain it. This is why the World Bank said this is the second best option, because it doesn't work. You bring prices down, well, that means, of course, demand goes down and wages go down, hours worked go down, and people hit the unemployment line. The real solution is creating opportunity in the economy for people to invest and spend. And manufacturing activity declined slightly in New York State in August, with new orders falling modestly. This from a research advisor at the New York Fed. Labor market conditions remained weak, not a good sign. And the Fed's bank gauge of prices paid for materials declined 23.4, while index of prices received by state manufacturers rose 2.4 points to 8.5, suggesting that, again, the higher prices are being rejected. And we look at the manufacturing sector and compare this to the labor market, it gets extremely clear here as current general business conditions for the New York Fed manufacturing survey. You see in blue going down. Well, that means the labor market's flatlining or going up. As we look at continued claims, and you see it happen again going into the global financial crisis. You see it happening into the pandemic, and now it's happening again. And this is all suggesting that we are right on the cusp of a recession. And even the report validated that, as meanwhile the 6-month outlook for overall activity eased nearly 3 points to 22.9, a sign that states producers are slightly less upbeat about the economy's prospects, as the outlook for orders climbed 4 points to 24.8, indicating that manufacturers are not seeing potential new order demand coming in to keep their workforce intact. That's why they're cutting hours. That's why they're cutting jobs, and why the intent to cap prices and put more money in people's pockets is not going to work. The real solution is fix the underlying problems with the economy, and inflation won't be an issue. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.